Hello, everybody. This is Daniel Wynn. How are you today? In this session, I want to talk about the benefits of private lending and some of the risks and what you need to do to protect yourself if you want to do private lending, trust deed investing, and mortgage lending. So I want to go over in this session about the benefits of it, tell you who applies for these types of loans and why you should consider lending to them. What are when you're closing a loan, what are the best practices for closing a loan? And then we're going to talk about defaults and other risks that you have to consider if you want to be a prudent private money lender. So let's get started. Trust deed lending and mortgage lending, it's the same thing. Trust deeds are in certain parts of the country, mortgages are recorded in the other. It's basically when you take an instrument that is recorded at the county that lets the world know that you are the lender of record. The two most important documents, and these are really the only two documents you probably need in order to secure your investment, but because of all kinds of reasons, there's probably about 15 or 20 documents in most closing packages. And if you're getting a residential loan, there might be 30 or 40 forms. But the two most important documents that you need when you're doing a mortgage is a mortgage or a trust deed, because that is recorded and lets the world know that you have this lien against the property in the county. And number two is the note, which is the promise to pay. It's a promissory note. The borrower saying, hey, I promise I'm going to pay you back. Here are the terms, the interest rates. If I don't, here's the other costs and things associated with it. So trust deed lending is when you have a mortgage or a trust deed recorded at the county. It basically also outlines the mortgage or trust deed also outlines the terms, the triggers, default, and recovery. So what are the benefits? The number one benefit of becoming a private money lender is that you are the bank. You make the underwriting decisions. You decide if you want to fund a loan or not. You get to create your own lending terms. And I would love to share with you my guidelines and the best practices that I've used over the years that have served me well. And I've been able to fine tune over the last couple of decades, because in the beginning, you learn every year. You're constantly learning. So a lender creates the terms, the repayment period, the interest rate that you're going to want to receive, the type of credit that you will allow, and the documents required. The lender then records the mortgage or trust deed like we just spoke about. And the number one benefit that you get is that you receive monthly payments from the borrowers. And they pay you those monthly payments. We recommend you use a third-party servicing company so you don't have to be bothered with that, accounting and calling them. And I've referred them in the past, but we use several different servicing companies. If you'd like more information, let me know and I'll be happy to send you my recommendations for your part of the country. Trust deed lending is also one of the best ways to diversify a typical investment portfolio. A typical investment portfolio invests money in stocks and bonds. With this, you're actually investing in neighborhoods and in people around you. You're investing in property, and you become a lender just like banks have been doing for hundreds, if not thousands of years. Also, if the borrower defaults, the lender can foreclose. And this sounds a little bit scary, and it can be if you lent too much to somebody, meaning that if the property was worth 100 and you loaned them 80 or 90, I would never recommend that. If somebody has a $100,000 property, you should be always under 65% and preferably under 50% of the value. That way, if anything happens where they don't make their payments, you have a cushion to recover your money. And last but not least, one of the benefits if they do default is that we include default interest rates and triggers in our documents, which allows you to collect even more interest because they defaulted and did not work with you. Who applies for private loans? Now, many people think private money loans and mortgage loans and trustee loans also could be called hard money loans. And many people think that the only people that apply for these are deadbeats, and that is far from truth. The actual truth is that you get a lot of people with good credit scores that could go to the bank. They just don't want to be bothered with the paperwork. They don't want to be bothered waiting for 2 or 3 months to get the money. They're out there buying deals under the value of the property. They know when they fix it up, they're going to be able to sell it at a much greater value and a profit. So they'll pay private lenders and brokers a fee, and they'll pay the higher interest rate if you can get this done quickly. And we like to say in our advertising that we can get a loan funded in 7 to 10 business days. And who else applies for private money loans are self-employed people. Now, self-employed people have a harder time getting loans, even if they have great FICO scores. If a self-employed person has a low FICO score, or if anybody applies with a lower FICO score, what's a low FICO score? So most lenders today have a 650 minimum FICO. Some have a 680. And under 650, the amount of lenders shrinks. And this is the opportunity that exists for private lenders like us and like you to be able to take advantage of that, because the banks are not doing those loans and there's less companies doing that, but the demand is still there. So when a borrower is under a 650 credit score, it doesn't mean he's a bad borrower. So whether they're a 50, 550, or a 650 credit score, all we like to recommend that you do is that you shift the loan to value lower. If a person has a lower FICO score, reduce the loan to value under 50%. Reduce it to 45%. If the equity is there, you get to make the rules. And this will serve you well if you follow this recommendation. So borrowers with minimum with low credit scores, people that are self-employed, people with high debt ratios, and people that maybe don't have seasoning. Many lenders have a seasoning requirement. Let's say that somebody passed away and left me, one of my heirs, aunts and uncles passed away and left me a $200,000 property, and I just went on title last week. Well, most lenders will not give me a loan until my time of ownership is seasoned for a year or 6 months. If that same person comes to me and they say, hey, I got this $200,000 property, I need a quick $75,000, I'm like, when do you want to close? And as long as I do the proper appraisal, title work, and insurance, I'm ready to go. And you should be ready to go because you're going to get a premium interest rate with a very low risk private money loan. When you close a private money loan, these are the best practices that you should have in your business in order to protect yourself. The number one practice is to have title insurance. So closing with a title company is always recommended. You should never close outside a title company. And you should never wire your money anywhere besides a title company. When somebody brings you a deal and you're going to close it, you make sure you call that title company, you introduce yourself, you get their closing instructions, you take a look at that policy before you ever wire any money, and then you make sure that you're also going to be in a first lien position. Secondly, you have to make sure that the property has proper property insurance. And property insurance, we like to recommend that it is paid 1 year in advance at closing, so you don't have to worry about getting notices that they stop making their payments, because every once in a while we receive those types of notices in the past before we implemented our 1 year in advance strategy. Also, it's highly recommended that you always use a loan servicing company. You don't want to be bothered taking care of the accounting, receiving the payment, booking it, accounting for it, sending out the annual 1099s and the other required documentations for collecting interest. Loan servicing companies cost $15 to $20 a month, and it's one of the best investments you could ever have, that they will take care of all this. Plus, you'll be able to go into their portals and look at your loan portfolio. They'll send you email notifications of everything that goes on with the loan, including the ones I like the most is when they send me a deposit notification saying that, hey, we just deposited your interest. So we call that email box money, because we get this email box money notification saying that the interest payment for the loan that I funded was just deposited in my account. And I get those almost weekly. Well, I do get them weekly, sometimes daily, depending on the way that the people make their payments. So it's very important that you build a team, a title company. We like Fidelity Title. We like Network Title in Illinois. You find a title company that you can work with. You go meet them. You go to lunch with them. You want them to have your back and to protect you and to let you know if anything's funky on the title. You want to find yourself a good servicing company. And property insurance, you have two options there. You can let the customer use their current insurance company, or you could find a company that you want them to use and recommend or make sure that they use them. We are very flexible. We like to let them use their insurance company as long as that insurance company lets us pay the premium for 1 year in advance, because they might be halfway through their contract with their insurance company. So we just ask that they renew it and start a new one with another 12-month clock. And just remember, if you need any help, you can reach out to us. If you like this video, if you like this podcast, please like it, share it with friends, and spread the word. So another question that we often get is, what happens if the loan defaults or other risks? We talked about that briefly earlier. If a loan defaults, the legal remedy is foreclosure. And foreclosure is where you turn it over to a law firm, and the attorney files a lawsuit saying that they have not made payments, and then you begin the collection process and the legal foreclosure process. While you're doing that, you will also be accumulating default interest. So you can set the default interest rate for whatever you want. It could be 16%, 18%, 20%, 24%. Check with your local state guidelines and usury laws. But you can set these default rates. So if they go into default, as an example in Illinois, let's say that our normal rate is 12%. We have a 24% default rate. So they're now obligated to pay us an extra 12% interest. And let me tell you that we collect that a large portion of the time. Yes, there's sometimes when we don't collect all of the default interest. And, we're not out there to hurt people, but if people put their head in the sand, then you want to charge them a premium for not keeping their word. You kept your word, you lent them the money. They were supposed to keep their word and make the payments on time and eventually pay you off. So that is one of the benefits. One of the negatives would be that, let's say that the property insurance does not get paid for them because it goes into the second year. Then you would have to pay the property insurance. And there's force-placed property insurance companies. It could cost you $1,000, $2,000. And there's also property taxes. And property taxes, you could pay them or let them accumulate while you're doing the foreclosure process, as long as you don't risk losing the property for property taxes. So when you engage a competent, experienced foreclosure attorney, they're really going to be doing all the heavy lifting. They're going to send you emails giving you a status of what's going on. Yes, you will have to send them some money. All of that money gets added into the loan, and you could add interest onto the money. So if you pay the taxes, you pay the legal fees, it adds to the outstanding balance of the loan. Check with your lawyer, check with your state, but oftentimes many people do capitalize those additional contributions into the mortgage and note that they created. Also, check with your state about the regulations for private lending and licensing. There's probably a dozen states that require regulation and licensing, and you should learn those as soon as you can. So let's wrap this up. A trust deed is a type of loan secured by real estate. Your best practices are to protect your investment with escrow, title, and property insurance. Many good borrowers will pay you for speed and convenience, and this is a great way to diversify your investment portfolio. I hope you enjoyed this podcast. See you next time. Like this, share it, and let me know if you have any other topics you want me to speak about in the future.